See if I could do this without a phone call coming in. Hey, business besties. I'm gonna let Facebook do what it does. But so I'm working on taxes right now. I'm just gonna give y'all an update right quick on what I'm currently doing, and let this get these notifications out. And once you pop in, say hey, hello. Let's see. I'm not too sure. I'm trying to see if I can see your comments. Guest requests. We're not joining. But yeah, so I'm sitting here doing these tax returns, and it's kind of like it kind of plays into what I'm gonna be talking about today. But there's a few things, a few that I wanted to cover. And I always got to do my due diligence and let y'all know taxes are due. If you filed an extension, they are due on Monday. All right. So you have to submit them by Monday. But say hey when you guys get in here. I'm not too sure. Swipe left to reveal comments. Let me know that you can hear me. Drop a 1 if you can hear me. Hey, thank you. All right, so I wanted to go over just a few things that I have personally seen while going through basically this tax season. Thank you. And it has been just like ups and downs with business owners that are basically keeping track of their finances. So I get some that are like, hey, here's my profit and loss, here's everything I made, here's everything I spent, and boom, we got it, we're good to go. But then I have others that are like, I need the whole entire year reconciled, and it's just, everybody is different. And so once we go through and like reconcile everything for, the client, it comes into basically what I'm going to share with you today. Oh, my glasses are like giving me a glare, but I can't see, so I'm gonna keep them on. So I gave you guys your tax extension reminder. All right, so we just finished up. We finished up a few clients, and we got their accounting right. And once you get that situation taken care of, it makes it a lot easier to go forward. So I was training this business owner, and just going through and saying, hey, this is what this is what it means. When we look at your financials, you made this much, you spent this much, here's everything you spent money on, and here's a total amount that you have left over at the end of the year. It could be a profit, it could be a loss. So reconciling everything just made a huge difference with understanding what the financials of that company was. But I wanted to bring to you guys a couple of things that 6 things. Let me make sure it's 6. 1, 2, 3, 4. Let's see. It might be 5. We might get an extra one in there. But I want to bring to you guys a few things that, I was talking to this client about, and basically what I broke down to them. So we're looking at the profit and loss, and we're going through everything that is on there. And after I took the information from the profit and loss, we have to put it onto the tax return. So a business entity is more so of sole proprietorship, LLC. A tax, how you're taxed is, by changing that entity to an IRS, basically the tax code that the IRS has for you, and that becomes like a S Corp or a C Corp. So if you are just a regular LLC, you are considered basically a partnership, or sole proprietor in their eyes under the IRS tax code. So this client was an LLC, no S Corp or anything, S Corp or C Corp designation. So what ended up happening was we were looking at their taxes. Mind you, where is it at? So this company made, and when I be telling y'all these businesses be getting to the money, this company made almost $350,000 for the 2021. Expenses, so it was at $350 for the income, $350,000. Expenses were at $210. Let me calculate that out so I don't tell y'all the wrong thing. That has them at income. Revenue that they were able to keep. Their net income was at $140,000, right? Now, this company was just an LLC. So when you look at the amount that's going to be put on the taxes, is basically going to show a profit of $140,000. Now, that person, this company, this individual, because, as an LLC, it goes on your personal taxes. This individual will now have to pay taxes, self-employment tax included with that, on that $140,000. I have not put it into the tax software, but when I saw this, I was like, oh my gosh. The plot thickens, because it's like, oh, taxes are real, and the IRS doesn't play. So, once you have this income being reported, you have to pay taxes on it. All right. So one thing, the first and foremost piece of information that we talked about is the tax savings. The tax savings of moving this company over to an S Corp or a C Corp, and also the tax savings that you can put into place by putting different strategies into place. Like, this company could have easily set up an insurance plan where their, executive was insured through the company, lowering the cost. You can put tons of money into different types of policies, but it lowers that. So if we were able to, drop in $40,000 into a policy, now that income goes from $140,000 to $100,000, right? Now their gross profit drops. That's less taxes to pay. Another thing is we could have set up like a contribution plan strategy where they put their money and consider a contribution to an organization, and then have that as a tax write-off. I know a lot of people like to go and buy cars and say, okay, well, let's just write off the whole car. That is an option, but there's other ways where you don't put it into a depreciating asset and you put it into an appreciating asset. So there's different things that you can do. So that was number one. So $140,000 this client's going to be taxed on. I'm scared to do the tax return because my thing is, like, I always try to have my clients pay as least as possible. We go through all the tax codes to see, okay, well, does this work? Can we put you into this category? Can we do this, and that? So, it was just like, oh my gosh, like, I don't even know, like, if we would have did this like today, if we were in 2022 working on, knowing what the income is for this client currently, like, I could have ran a profit and loss for the first 3 quarters and said, oh, hey, wait a minute, we got too much money that you're going to have to pay taxes on. Is there anything that you want to put into place so you can keep this money here in your pockets and you controlling it compared to giving it to the IRS, right? So if we would have done this in 2021, like let me go back. We're doing this for last year. Like, we're going through taxes for last year. If we would have did it in last year's time frame and would have been able to say, okay, well, here's the accounting, this is what your numbers look like, we would have been able to take a look at possibilities to do the taxes and have that stuff written off. We too late in the game. Like, we're a whole year almost later. So it's like, I can't help you if we're not, taking care of stuff beforehand. Instead of being reactive, like right now is reactive. We're doing the taxes for this client in 2022 in October. This is reactive. But going into next year, 2023, we're being proactive right now by going through and doing the taxes for this current year and saying, okay, well, this is what it is for this current year. What can we do now? What can we put into place? What strategies will help you for next year? All right. So always be proactive, not reactive. And, you know, the first thing is basically there's different strategies that you could take to lower the tax savings. All right. So another thing was, this client was, so what I like to do is I like to go through and understand what your goals are for the business, how you want it to grow, what, you know, what you're currently going through to see, okay, well, let me go see how we can help you during that process. Where can Legacy jump in and say, okay, well, we could do this, this, and this, you know, here are your options. And one of the things this company wanted to do was hire more employees. Now, they didn't understand where they were financially to say, okay, well, we can do that. Like, money's rolling in, obviously, right? Money's rolling in. It doesn't seem like it's an objective, right? But if you don't know and you can't see what you're actually doing in that company, then, you know, it makes it a little bit harder to say, okay, well, if I did this, it would be okay because I already know what I got going on. So we were able to project out with this client, basically, here's where you're at, and, you know, hiring, because they currently have employees, but hiring more will be able to do this, this, and this. And you will see that return next year based off of that. So we were able to take those numbers, come up with a conclusion or a hypothesis, basically, of, okay, well, here's what it is. You know, it makes the risk a little bit less riskier, I guess, just because you know what's actually going on and you know where you're currently at. So, you know, going through and understanding what their accounting and their financials look like, basically let this client know that they're ready to hire new employees and, you know, see the return on that. So another thing is once you get this set up, once you go through and get your accounting set up, once you know your financials and you're keeping track of them, you get to know, like, your starting point. First off, like, now we have a starting point. We could say, okay, in 2021, this is what you did. And now going forward, as that business grows, we can say, you know, in 2022, first quarter compared to 2021 first quarter, boom, here's your numbers. You have a way to track and understand what is going on with your company. It lets you know if you're losing money, if you're making money, where you're going with the clients, if something is, you know, if you got a product that is popping and people just love it, you will be able to track that. All right. I've seen it time and time again where a client comes in and they're like, well, you know, I'm selling this product, but I don't really know if it's something worth keeping. Like, I don't know if, you know, if I'm selling a salami sandwich and there's a ham sandwich that just seems like it's always gone, but the salami's always there, you can track that. You can track if this item is worth keeping around. I think that's probably why, like, Taco Bell changes their menu so often, because they can track, like, okay, well, people are buying these nachos compared to people not buying, you know, this type of taco. I don't know. It just makes me mad every time I go there and they don't have the same menu. So you can track all that stuff, you know, as a business owner. And that's one thing that comes into play when you have your accounting set up. Another thing that we get a lot of, I'm laughing because we get a lot of this one. Business owners not knowing what to write off, right? So, you know, if you're going to the spa, or if you are going to, where can we go? Where's one I've seen recently? If you're going to the spa and you're taking your significant other to the spa, and this has nothing to do with any type of business, it should not be in your profit and loss. Sorry, got music in the background. If you are buying something for the company that is going to directly benefit that company, then it's a write-off. I get a lot of clients that do a lot of commingling. So commingling is basically this. You got your personal, you got your business, and they're all together. That typically happens when you have one bank account and the money's going into there and you're using it for GameStop is, well, it just depends on the business. But commingling happens when you have one bank account and you're going through and you're using that bank account for your personal and your business. All right. You have to know what you can write off. The cleaner you have your business financials and your business transactions, the easier and less time consuming is going to be on the other side. Okay, so if you are having to go back and go through, you know, all your runs to GameStop or I'm trying to think of write-offs that is just like, no. Like one of them, like specifically that was recent was like going to the spa and, you know, concerts and stuff like that. Okay, so obviously that is not like, they're not taking their employees to concerts or all this other stuff. So that kind of stuff is, you know, is commingling of your funds. You're mixing your business with your personal. And that was one of the things that I see a lot. This client had that I was talking about. This client had that also. And you know, you come to understand, okay, what can I write off and what can I not write off? And when you get somebody like, you know, Legacy doing your accounting and we're like, hey, we're typing you a letter and saying, hey, like, is this a write-off? You're going to start questioning yourself like, oh, dang, I don't want them to ask me this question again. So, you know, we kind of just, you know, tell our clients like we're spending more time having to determine if this is business or personal. Here's your expense report. Can you tell us what this is for so that we can make sure your accounting is clean? So that is one of the things, another thing that I always see. So I'm going into 1, 2, 3, 4. I got 5. Okay. So another thing, like I said, with this client, they brought in $350,000, right? They spent $210,000. So their net profit, net income was $140,000, right? So another thing that comes in when you keep your accounting and your financials right is, I'm going to take a second because this is one of the biggest key factors. I mean, it goes back to tax savings just a little bit, but it's one of the biggest key factors that I personally tell people they need to understand their financials before they do this. So this client is at $140,000 net profit. This is like basically like, okay, well, you got this, but you spent this. Here's what you have left over. One of the things that I have a lot of clients do, and most of them are doing it too early, is they switch their company tax codes to an S Corp. All right. So when you're going through your financials and you are making money, but you're also spending majority of it, or you're going, you know, you're having a loss at the end of the year, that will tell you if you're ready to become an S Corp. So basically what an S Corp and C Corp does is it taxes you differently. So right now, as an LLC and a sole proprietor, if you don't have an LLC, you are a sole proprietor. But even if you have an LLC, you're still taxed as a sole proprietor, unless you have partners. All right. So when a client comes in and they understand what their financial status of their company is, that will let us know, like, okay, if you're an LLC, you're going to have self-employment tax, right? The self-employment tax is based on how much money you're keeping in that company. So if you are, you know, not keeping much, it might not be the best option to switch over to an S Corp. But 140 that I got here, they're going to be taxed on $140,000 through self-employment tax. That is going to be crazy. Crazy. It's going to be crazy. I don't even want to look at it. I'm scared to do this tax return. But they're going to be taxed on that. So this client is somebody that I would say, hey, you might, like we did the projections like I was talking about, you might want to switch over to an S Corp sooner than later. Because right now, what an S Corp does, it removes the self-employment tax. So it kind of comes with stipulations. It says if you're an LLC, you're going to have self-employment tax. You have a little bit more freedom with everything that you do. You do not have any criteria for making sure that you have accounting in place, or, having employees and, paying yourself and all that stuff, right? But once you get over to the S Corp, there are stipulations. There's rules and codes of conduct. You're going to take on extra expenses. And that's where you kind of come in play with, okay, what do I want to do? So if you have self-employment tax and you're paying, 10, 12 plus, I've seen 30,000 in self-employment tax, because this is going to be higher than that. 30,000 in self-employment tax because they're an LLC. But if they were to switch over to an S Corp, they lose that 30,000 right away. Once you switch over and have that designation, that self-employment tax goes away. Because now what happens is you take on, now you have to have accounting. Now you have to pay yourself as an employee. Now the business accounting has to be taken care of. So you have those extra expenses, but it's not $30,000 worth, right? So S Corp, you lose that self-employment tax, but you also take on the list of stuff that I just named. It's going to be a lot cheaper, first and foremost. And the other side of that is the income. So let's just say, this client has $140,000. They decide to pay themselves $50,000 for the year. Okay. Now they're only paying $50,000 taxes on $50,000 of income, because the business is now paying them however they get paid, every 2 weeks, every month, however. So they're only going to pay taxes as an S Corp on the money that they receive from the company. So that $50,000 is what they're going to put on their tax return. They're going to pay taxes on that. They're not paying taxes on $140,000 anymore. Now, on top of that, $140,000 minus that $50,000, I'm not going to even try to think, is $90,000. That company now has lowered how much they're going to be taxed on. And then, it went from 140 to 40. 140 to 90. And it just makes a difference overall. So S Corp, you do take in administrative costs, so accounting, payroll, and I can't think of the other one I just named, but you got to weigh out your options. I personally would only tell somebody to switch over to an S Corp when they are over 60,000 in profit, somewhere around there, because the amount that you're going to have in administrative costs are going to be about the same if you just left it at an LLC and paid those self-employment taxes. So that is something that a lot of people do it backwards. They start off as an S Corp before the business has even taken off. And now they're just like, oh, now I got to keep up with all this stuff. I have all this overhead and I'm not even making that much money. I'm like, why? Why would you start with an S Corp and your business isn't where it should be at? So that is something that I always see, and it is what it is. You can change it, but I would say just start making more money and keeping more. But it really just depends. So that was the other thing that I always see when I go through and do the accounting for people. But yeah, so overall, keeping track of the stuff that is on your accounting on your business, how much your business is making, how much it is spending, and knowing where you currently stand and keeping up with that. Like I said, we need to be proactive and not reactive. We need to make sure that this stuff is set up and ready to go, so that, you know, throughout the year, you know where you stand. You know if you need to put some tax strategies into place. You know if you're ready to hire employees. You know if the business is growing. You have something there that says, okay, well, you know, this is where we're currently at. You know what to write off, and you're not commingling funds. And then really just staying on track of everything. And then the last thing is you just know what entity. You know how you can save and how to do it. You could save by changing your entity off top if you're there, like if that's you. So so much can come from monitoring your business finances that I'm an accountant. I've been doing this for 14 years, and the numbers don't lie. The numbers don't lie, but they also give you the knowledge to understand where you currently are at. So another thing is, if you keep track of your finances, you understand, okay, well, I can run this report, and you get all these notices. As a business owner, you get so many notices, and you got so many things to pay. Like, I can't even keep track of all these different places that say, okay, well, you're going to be taxed for your business license. You're going to be taxed quarterly for this. You are going to, you're going to pay quarterly taxes. You're going to sales tax, all this stuff. Like, there's all this stuff. And if I don't even understand how people can't do their financials, because if you are looking at, okay, well, now I got to report this, and they want to know how much I made, and, you know, all this stuff that they want, if you can't just run that report and get it done, that just, it would be such a headache. I've been there, and it just drives me crazy. So, you know, keeping up your financials also makes it so easy to keep track of all these different organizations that are saying that you need to keep these, you know, different things in place. So that's another thing that I had on here. But I did this because this client has me scared to do the taxes. But, you know, we are at that point where on Monday is the filing date for your taxes, right? So I'm inviting you to, you know, if you need that assistance, my team can actually help you get your accounting in order. We can help you get your taxes in order. We can do prior year taxes. We can do all of that. You just got to take the initiative. But the other thing that I'm super excited about is I am starting a training session, a lot of different training sessions. It's basically my Business 101 training sessions. I don't have a name for it. Can you tell? But it's basically Business 101. So my goal is I want to go through and help other business owners in different areas. Marketing, I had a list. Marketing, planning content, creating their own omnipresence without paying for it. Having online events, having hiring employees, hiring virtual employees, and a lot, you know, the list goes on. But I wanted to come through and invite you to my first one, and it kind of falls in line with this. I am going to be doing a QuickBooks Masterclass, and we are going to get to understanding how QuickBooks works, setting up your accounts, making sure that everything falls into line, connecting stuff. I want to make it as simple as possible, so I'm going to show you how to do that within your own QuickBooks. I want you to walk away with an understanding of, like, this doesn't have to be hard. It really doesn't have to be hard. You don't have to pay me to do it. I love to do it, but you could do it yourself. So, you know, once you're going through and understanding your business, it makes a huge impact when you go through and understand this stuff yourself. Like, you could pay somebody to do it. That's okay. I do it all the time. But at the end of the day, I still need to learn it because I'm the business owner. It all falls back on me. If somebody doesn't show up or they, let me down, I have to make sure it gets done. And I want to train other business owners to take initiative and do all these different things on their own and learn how to do it. So you don't have to depend on anybody else. Keep your overhead low and, take care of different things like this. So that is going down October the 27th. I do not have a time yet, but that will be my first training, our QuickBooks training. I'm going to be dropping the links in here. I think it's actually already in the boot camp right now in the page, so you can just scroll down. But either way it goes, I'm inviting you guys to that. I hope this made a whole bunch of sense of how important it is to make sure that you understand your company financials and what is going on within your business and how it can help. So that is all I got for you guys. I hope that you guys have an awesome day, and I will see you in a little bit somewhere else. Yes. Bye, guys.